Welcome to Livewire Markets. My name is Vishal Tekshanani. Thank you for tuning into The Pitch. Today I'm joined by Billy Leung from Global X. He's a senior investment strategist, and our topic of discussion today is going to be US exceptionalism and what Trump 2.0 means for investors. Billy, thank you for joining us.
Thanks for having me.
No worries. So Billy, Trump 2.0 is in full effect, and without going through the full inauguration quote, we know what Donald Trump wants to do. He wants to make America great again. He wants to make America more exceptional. What are the key policies you're watching that could reinforce that vision of US exceptionalism?
It's great that you said that he's still following through his, standard view of what he saw during his first administration, and I think it's exactly he's trying to follow through from what he was intending to do. So I think one thing that we're definitely seeing and looking for is definitely how he deals with the trade and the tariff policies, which we're seeing again in full effect right now. We've seen Mexico, Canada, and China. All these tariffs are in place right now, and we're also seeing that tit for tat as well. So I think this is one that we should be following, but at the same time, taking a step back, understanding that the expectations going in were actually very high. People were expecting, for example, incrementally 60% tariffs for China, but right now it's probably about cumulative 20 to 30%. So I think we have to compare with what the expectations were and what they were or ongoing now. Number two is obviously the tax policies, the corporate tax policies, and this is probably more of a continuation of the 2017 tax cut policies that Trump instilled, and I think there's a very good likelihood that he will continue this tax cut. So in terms of the actual tax level in the US, it will be maintained, so it won't go back to the original level. And I think lastly, one thing to really look at is how he deals with, technology, and this is one thing that he's very much focused on, in terms of bringing back this innovation into US or competing innovation globally as well. So I think it's more about these three key policies or key trends that Trump will be looking at.
Okay, so I want to focus on the Trump tax cuts, so the extension of the Trump tax cuts. These are worth $4.5 trillion, so very meaningful to the US economy. Which sectors stand to benefit the most under this administration, and are there any hidden risks investors should be aware of?
Yeah, so when you look at tax cuts, I think one thing to look at is obviously areas or companies which are most sensitive to lower taxation rates. And to be honest, a lot of these will probably be more, domestic focused companies like industrial companies, even financial companies and healthcare companies, where traditionally they've been paying higher tax on average, as you'd assume, where compared to maybe a more technology focused or innovation companies which have a lot of tax benefits. So I would say beneficiaries will be mostly focused on these areas: financial, healthcare, and industrials. I think in terms of hidden risk, we also have to look at whether or not some of these tech companies are going to be paying more tax or paying less tax. And what's interesting is, I wouldn't call this I'll call this a risk, but probably an upside risk is that there's a misconception that a lot of the, major tech names such as Amazon, Facebook, and Meta, that they're paying very low taxes. But if you look at their annual reports, look at, their recent results, they're actually paying quite a high effective tax rate, maybe close to about 19%, which is close to about 21% on average right now. So I would say the risk, or even the upside risk, is that even some of the innovative companies could potentially benefit, even if that, continuing tax cut comes in.
So Billy, the US real GDP growth is forecast at 2.1% in 2025, outpacing other developed markets. Do you see this growth broadening beyond mega cap stocks, and how should investors position for that?
Yeah, so we definitely do agree with this, and we do have a strong conviction that there is that US exceptional here because of that higher growth. And we do agree that they will be driven by a more broadened of the market growth. And one of the key things that we look at is in terms of the subsector growth. So what we've done is, for example, look at the S&P 500, and we've broken down these by sectors, IT, financials, healthcare, industrials, whatnot. And what we saw during 2024 was that it was very much tilted towards IT. Obviously we saw a lot of tech growth and some consumer growth as well. But what we see in 2025 is that in terms of the S&P 500 growth, it's much more broader. We're seeing growth in areas such as healthcare, even energy, industrials, and also financials as well. So it's much more broader in terms of what we saw in 2024. So that sort of supports our broadening theory. So we're not saying, sell your mega tech names, but I think there's a very good case to expand your exposure into the other segments, or the lagging segments, I would say, in the US. And again, like I say, it's the industrials, the financials, and the healthcare.
Okay. So despite the strong outlook, we do have some dark clouds over the horizon, trade wars, the uncertainty over which way interest rates could go if we see inflation back into the system from higher consumer prices, right? So what's the best way for investors to hedge against these risks?
We're still telling investors or advising investors that, there is still a very strong case for equities, but, we totally understand that there is a spectrum of risk as well, and obviously trying to manage this risk, especially during these times as well. And, what we've suggested that in terms of still holding your core equity portfolio holdings, whether it be US or Australia, there are some ways to actually minimize the risk or manage the risk, like you said. And, one of them is obviously through gold, which has been a hedge against inflation. That has always been a strong product and well-used product in a portfolio. Number two is always, we also have, I guess, the cover call strategies that have come in. These strategies allow us to, I guess, minimize both the upside and downside, but at the same time, we do have a very regular income stream because we are, holding the underlying and also writing the call option of the same underlying, which is just a really good blend and a really good income structure. And finally, there's also very strong, I guess, very interesting fixed income products we're seeing in Australia right now. For example, in Global X, we have an Australian bank ETF, which is called BANK in terms of ticker, and that provides investors with the major banks' debt in the portfolio, and it gives the investors about a 6% running yield on an annual basis, and it's paid monthly. So all these products in terms of hedging against volatility provides us with that income during times of uncertainty.
Okay, very good. Billy, thank you so much for coming in, talking to our audience about the economic situation and providing some tangible ideas. Really appreciate it.
Thank you.
I hope you found this video insightful. Please don't forget to like it, subscribe to our channel, and do your thorough research on these products, please, before considering investing in them. My name is Vishal Tekshanani. Happy investing.